all those data points that are going to possibly put the brakes on. And you have to add to that a problem in Europe now if they have a deflationary crisis or inflationary depression, I guess is what you'd have to call it now. I almost feel like Powell is so worried about this is like meta, so worried about his legacy that he actually is Volckering now. And so the conclusion is, if he becomes overzealous at fighting inflation now, he'll have to be overzealous at fighting depression later.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, quite excited to have a new guest on the show who is Vince Lanci, although as I've been hearing some of his interviews, quite a body of knowledge. So I think you're in for quite a treat today. And Vince is the owner and operator of Echo Bay Partners. He also runs Goldfix Substack, where he publishes some of his great research, also a professor these days. So sharing his knowledge in a lot of forms, and certainly with a lot going on in the financial markets, getting closer to the Fed's next rate hike. Fortunately, Vince, an expert in gold and silver with a trading background as well. So a lot to dig into. And Vince, quite a pleasure to have you on the show. And how's everything going with you today?
Well, first of all, that's like the best introduction I've ever heard. I almost want to watch now, you know. Thank you very much. I'm happy to be here. I'm very happy to be here, and I'm a big fan, and I appreciate this. I appreciate the conversation we had beforehand. I mean, that was a show in of itself to me. So anyway, I'm with you.
Well, it's great to have someone who has experience in the markets, and also I can see that teaching expertise coming through. So it's going to be great to dig into some of these things. Perhaps before getting to gold and silver, we'll leave that a little bit later, but maybe good to start with what's happening with the Fed, which will really set the stage for that. Again, looking like 75 basis points. And why don't you start there with what point you see the Fed at? A lot of people expecting a pivot. And I think there's debate now that people still expecting a pivot, but might be a year or two out unless something breaks beforehand. So why don't you take it from there and what you're seeing, and then we'll dig in from that.
Well, about a month ago, I was asked those type of questions, because right about a month ago is when not a little bit before the Jackson Hole speech, we were getting the vibes that maybe the pivot's not going to come. And it dawned on some people, probably yourself included, that they might not be a pivot. In fact, I think you said it off air. You said, not a pivot, a pause, if we're lucky, And the Jackson Hole speech is what I think changed the sentiment of the market. Most people understand that. He had 30 minutes to speak. He only spoke 8 minutes. He basically said, this is what I'm going to do, like it or leave it. And that was something that he was pulling back on communication to try and control the narrative a little bit more, meaning keep them guessing a little bit. But that analysis aside, the market before then was thinking rate hike and then pivot. Now the market is thinking rate hike, as you said, and then pivot a year from now, or maybe pause, 8 months from now. But I think, I had a strong opinion before, but it was flexible. And the opinion was that I didn't think the Fed would pivot as soon as everyone else thought, but I thought they would pivot. I said, all right, they probably want, 2 week inflation, just to give you some data triggers, 2 in a row, really weak inflationary numbers. And I'm like, okay, then the pivot's on. Or stocks crash, then the pivot's on. Or there's a big event, like a credit-related event, which would probably coincide with the stock crash. And so they would have to rescue something, and then your pivot comes. But, the Jackson Hole speech, but the thing is, I was like, Powell was so wrong about transitory. When he was signaling Volcker, I thought it was a sham. Signaling Volcker, I'm going to be tough, And so I started reading the history behind Volcker before Volcker. And I'm like, Powell's more like Burns. And so I started to think like Burns, who presided for 70 to 78 over the failed policy. In 1978, and this is why I'm about to flip on Powell here. In 1978 or 1979, Burns did a speech in, I think Sweden, I'm not sure where. And he basically went down a laundry list of why he failed at keeping inflation under pressure. And Volcker was at that meeting. And Volcker left that meeting and immediately raised rates and just started the whole October of 79 is when it started. And this speech was in August or September of 79. And at that moment, I said, you know, in my own bias against Powell, I said, oh, Powell doesn't have the political will to do this. Powell's Burns. He's not Volcker. Powell's got to screw up, and whoever comes in after him will pick up the pieces. And then the speech happened at Jackson Hole, and I said, oh, no, maybe Powell really does care. So my conclusion is all those data points that are going to possibly put the brakes on, you have to add to that a problem in Europe now if they have a deflationary crisis or inflationary depression, I guess is what you'd have to call it now. I almost feel like Powell is so worried about this is like meta, so worried about his legacy that he actually is Volckering now. And so the conclusion is if he becomes overzealous at fighting inflation now, he'll have to be overzealous at fighting depression later. The rubber band has been stretched so much that the snapback is going to be too much. Our unemployment is too low structurally for our inflation. We have to have higher unemployment to balance out with the inflation. And so to answer your question or you know, your lead in, I don't think the Fed pivots at all for the next year. I think we may have a pause or two. And reason I say a pause or two is because I have a feeling that we might get, say, 2 inflationary numbers that are very low. Inflationary numbers, not GDP numbers. They're literally ignoring, I think this is key. I've been focused on recession. There's going to be a recession, he's going to have to pivot, right? We were all thinking that. It's going to be a recession, he's going to have to pivot. Well, we're in a recession, technically. I know it doesn't feel like a recession, but by the book, we're in a recession. And they have successfully gotten the word recession out of the headlines. You know, we're not talking about 2 GDP quarters in a row that are down. We're still talking about inflation. And I'm like, oh my goodness, they've successfully convinced the public that we're not on the brink of a major recession. And maybe we are not, but they still have us talking about inflation, which is not going away. And it made me rethink. And my rethought is I think Powell's going to be on the brakes too long, and then I'll have to be on the gas that much more when he comes. But I no longer think that it's going to happen in the next 3 to 6 months at all.
Yeah, it certainly doesn't. And I was a little bit surprised that it took until Jackson Hole for the market to see it that way, because he was pretty emphatic about it, some of his earlier meetings. And then we had that big rally, which it was almost like people just didn't believe him yet. You know, on another hand, when you see prices going up as high as they are, it's kind of hard to ignore. Although that leaves the question, which you just touched on a little bit, but does that exist, that balance where you can navigate through this? It seems as almost if the answer is to go back 10 years in time and not do QE 2, 3, and 4. Is it possible to maneuver that where whatever set of interest rate hikes it would take to actually make a dent in inflation, does something break before then?
That's the question that they're asking themselves. That has to be what they're asking themselves. That's a banker's question. You know, what can I do to get inflation down without breaking the economy? And you know, it's the cliches and analogies that we had been using for years: the sugar high, the coming off of the addiction. You know, the caffeine and alcohol combination addiction, or something obviously much worse potentially too. Well, we're actually in it right now, and structurally, secularly, beyond macro, I think most economists on the academic and political side look at things from a static equilibrium, you know, a chart left to right. They don't look at them in dynamic equilibrium. Well, in static equilibrium, it's like we were at 2% before we were at 2% inflation, we're at 0% inflation before with 5% unemployment. Then we should be able to do it again. Well, no, it's a completely it's not a two-pronged dynamic, it's a three-pronged, it's an ecosystem, you know, and for all the reasons that COVID kind of like pulled the veil back on, I don't think there is a level that we can get to without retooling our whole economy. And by the way, that's what happened in 79 to 85. We stomached the high unemployment. I'm not saying that we wanted to willingly. We stomached the high stagflation, 13% inflation, 8% unemployment and higher. And we remade ourselves economically. And we need to structurally remake ourselves. And just to echo something that you reminded me of, before we pulled out of Bretton Woods in 71, before we went off the gold standard, we were a country that made, and we made those things. And so financialization wasn't the engine of our economy. Production was, right? And then when we realized that we had, two wars to pay for, 1971, we go off the gold standard, and now we become a financial company. So for every dollar that's made, we create $100 in, wealth off it, kind of the Exeter's pyramid thing. Well, it's reversing now. The real things that are the collateral for like gold and natural gas, that are the collateral for the money on top, for the wealth on top. Well, they're on strike. Commodities are on strike now, and they want to be paid more. That's what Russia and China are doing. And so it ends with, if half the world wants to go back to a more sound currency, and you are dependent on them for supply chains, if you don't retool, you will have that 6-7% unemployment before you get stuff back to normal. I'm sorry to say this, but we need to lose a generation. I say that because that's what happened to my father's generation. They got killed. So long-winded way of saying, no, you can't get inflation to 2% without getting unemployment higher than 6%, in my opinion, and or GDP very negative. So there you go.
Yeah, it seems like it'd be tough to do that even in normal times, but like you were alluding to, you have everything that's going on in Europe where, you have the inflation going on globally, but you have debt crises all around the globe, and especially now you have Europe, which seems to be on the verge of getting their energy turned off by Russia. So it's almost the worst time that the Fed could be in this situation, and one of the biggest trading partners going under. And curious how you see that playing out. Had a sharp guest on last week, London Paul, who talked about basically it seems the dynamic is that either they don't get energy unless you have an apology from European and American politicians, which doesn't seem like the kind of thing that's likely to happen.
No.
So any thoughts on where that's heading and how that all fits in?
Yeah, I haven't given too much thought of what undoes it. Maybe I should start thinking that way for the exit strategy here. But I do think that first of all, just to finish with the Fed, whether intentional or not, the United States as an idea is basically trying to outspend Russia again in the Ukraine war. And so can we take inflation and recession before they take depression? They could have a depression because their velocity of money is going to slow down. But to answer your question on that, the genie back in the bottle. No, I don't think it can go back in the bottle. And to respond to what your previous guest said, yeah, that makes complete sense. Putin is slighted. The East is slighted. They need some sort of remuneration or apology. from the West, but the trust is broken. We're going. I mean, I've said this for a while, and it's gone that way. We're going back to we're back. Even if tomorrow, if Putin said, "I'm pulling out," we've made our point. I'm pulling out. Hooray! And everyone goes to the neutral corner. That's 10 years of neutral corner. That's Cold War stuff. That's not going to heal overnight. And during that time, which I think we're betting on, we're going to try and heal our supply chains internally, buy American, all that stuff. Chips will become more important. But I don't think it goes back. I think at best, and this is an echo of what you said about in a good time, this will be hard to do. At best, even if everything were to be fixed, right? We're two worlds now, at least two worlds. And if you look at and I'm not saying we're going to go to World War, but if you look at history, the reason that we had World War I, okay, was, the Archduke being shot, but it was because of mercantilism. The European countries had all started colonizing, and Germany was left behind. Germany was for some reason was delayed in uniting. It's all like archaeological stuff. I don't understand it, but when it happened is when you go mercantilism, it's like when the world had a very big global unity at that moment. And in 1914, it broke down. And so some country in the middle of all that mess, they get deprived of assets, they get deprived of resources, and so war starts. And that's what I think we're headed towards, meaning some satellite country is just going to get squeezed so bad, and maybe that's kind of what Ukraine is indirectly, that there's going to be another skirmish of some sort. And even if there isn't a war, and I'm not predicting one, nobody goes back to the neutral corners and comes back shaking hands. I'm prepared for this to last 10 years, and I'm prepared for the new monetary order to probably kick in about 2 years. I don't know if that answers the question, but.
Yeah, well, that makes a lot of sense, and especially interesting. Call it the new monetary order. We saw throughout the past couple of months, at one point, a partial gold backing to the ruble by Russia, and
right.
Curious where you see, or perhaps you could just expand on when you say new monetary order. What do you think that looks like? I mean, we hear Moscow World System, they're setting up precious metal exchange,
Yeah,
and talking about a currency basket. Any thoughts on where that is heading?
yeah. I mean, there are a lot of moving parts, but you pretty much nailed all of them in one area. And I read a lot of Zoltan Pozsar stuff, and for some reason, I understand what he's talking about, which is not easy. He writes 4,000 word pieces. Money is okay. Trade is international, and what's going to happen is you're going to have, as I said, the natural resource producers are kind of a little bit on strike. And the result of that will be, if Russia can't spend rubles in the West, then Russia's going to spend them in the East. So it's going to play out like this. They're doing it. It's happening right now. Number one, gold is being refabricated to different specs by the Saudi Arabians. It's being stored in China. So China is storing the gold. Everyone in the East is buying the gold. And the gold will be used in a competitive, what's it called? The Moscow Standard? Is that what you said?
Moscow World Standard.
Moscow World Standard. See, it's kind of like they're global, but they're not. So, it's like their game versus our game now, when you think about it. So that's going to compete with the LBMA. And the reason this is extremely important, and I think not talked about enough because it's down the road, is that when you start transacting gold in half of the world, in that half of the world, it's not going to be priced in dollars anymore. We'll be talking about grains and yuan. And when the price, using gold as an example, but this applies to all commodities, even though gold's money. When trade is priced in dollars, you have to have dollars. That's the dollar standard, right? The dollar reserve currency status. Well, what ends up happening is we're buying less stuff. Uh, people have yuan and they have rubles they want to buy oil with, and we can't stop that. But what ends up happening is things start getting priced in other currencies, and when they get priced in other currencies, like on the Moscow World Standard, you end up getting the pricing power relocating from the west to the east. So people who don't like the COMEX, when the COMEX dies, it'll be because there's another exchange in the east that's getting all the volume. And when they get all the volume, that'll be where the price is set, almost like from trading places, turn the machines back on type of thing. Well, what'll happen is there will be two currencies. There will be two world currencies. There will be an Eastern Bloc currency and a Western Bloc currency. The West will hold on to fiat as long as it can, ideally. The East will move away from fiat as much as it can, ideally. The East will have to have some dollars to get the things they need from the West, whatever we have that they don't, Lee jeans, who knows, Levi's. And we will have to get, whatever we need to get from them, to simplify it, nesting dolls. But for trade at the international level, it's going to go mercantilist. It's going to be, we have gold, you have gold, and we have current accounts, and we'll do trade, and we'll just net our gold out. You're going to have two currencies, East and West, number one. The West, in an attempt to counteract the East action, will create something that Pozar calls Bretton Woods III agreement, which is basically they're going to create a basket of currency equivalents so we can trade with the East. So we all know about SDRs. They're going to create like a natural resource SDR. Gold will not be in the West, but it will be in the West indirectly. They won't admit it, okay? It'll be made up of economic commodities, oil, natural gas, grains, whatever, butter, sugar, who knows? And we will use that as our store of value when it's kind of like when the East says we want to see your books, it's like, here's our books, and when we want to trade with them, we'll say, okay, we'll give you 2 units of our SDRs. But meanwhile, in the West, trading with the West, you won't be buying beluga caviar. You'll be buying, I don't know, chicken eggs over here. And so we'll be using some sort of a central bank digital currency. So the store of value will be at the international level for trade, and the local money for us, and probably for them as well, will be almost like a Star Trek credit. I mean, that's kind of dystopian, but in 2 to 3 years, we will have 2 separate world currencies, and there will be a bridge between the East and West, and it'll be some sort of a trade agreement, which is going to be very similar to mercantilism before the First World War. There you go. It's going to happen.
Sounds like a lot that they're leaving us to look forward to. And in terms of that Moscow World Standard versus the LBMA and COMEX, I think that's certainly a lot of folks who watch my show are wondering, is this the end of seeing gold under 2,000, silver under $20? Is, I guess, perhaps a little bit early to know how that plays out, but is that something where most of the metal starts trading through there and we see a change in the pricing environment?
That is the riddle, right? That's the problem. Meaning, is it going to be meet the new boss, same as the old boss? I mean, the West likes to keep the price of gold down because of neo-Keynesianism. They want the money to be dynamic, and they don't want it to be a store of value, and so they want it to grow for good and bad reasons. And so gold is the only real trusted competitor with a track record against the dollar. It's got the bigger track record, but let's be fair, right? And silver as well. And so the price of gold is low. For whatever reason, or however it's been kept low, it's low. So now you go to the East, right? To your question, you say, okay, well, are they going to free up the value of gold? Or are they just going to do the same thing because they want money invested locally? So I thought of it from an Indian perspective, not China, because they're kind of in the middle. And I'm sorry to say I don't have an answer, but I do know what the choices are. In India, you have a lot of gold ownership, and the Indian government is trying to get people to take their money out of gold and put it into the economy so they can grow the economy. Very similar to what we did. Get your money out of gold, make it work for you. Buy stocks, And they're having a hard time doing it because of the culture is still generationally worried about whatever they're worried about. And so they put a tax on it, 20% if you buy it, 30% if you sell it, 50% if you look at it. And they're really having a hard time getting people to get rid of it. And so it just goes underground. And so I look at India as, in this case, a proxy for the East. And I go, all right, well, if I'm India and let's say the COMEX closed tomorrow, boom, and the COMEX reopened under new management, but it's still called the COMEX in India, what would the price of gold do? Well, the East would want the price of gold to go up because then they'd have more wealth with which to buy, simplifying it, stuff in the West. We want to buy New York City. We want the price of gold to go up so we can go buy it. Because everyone, even if the West hates gold, we have to agree on okay, that's what it's worth. We're not manipulating gold, we're manipulating the dollar. So I'm looking at India and I'm saying, all right, if I'm India as a country, I want to keep the price of gold down domestically so that I can get people to put money in my economy. But I want to keep it up for our Eastern Bloc. And this is why it's so, you really touched on something I don't have an answer to that's really annoying me. Will we get the new boss same as the old boss? And I think yes. Will we get countries that want the price of gold to move more freely so they can show the value of their storage value? And so, unfortunately, I'm laying out the problem, but I don't have the answer. What do you think? Do you think, digitally speaking, does gold stay where it is more or less, or does gold go up like it has gone up in every other currency except the dollar? Like, what happens? I don't know.
Well, I know what you mean, because what really drew me into this 10, 13 years ago was seeing, even aside from the money printing,
Right.
once you see that the debt's being piled on, and if you accept the fact that Pelosi and Schumer and all the other guys, talk about deficit reduction, but once you get to that point where it's like, wow, that may not ever happen,
Right.
someone's getting stiffed on it, and I guess certainly it can go on for a long time. Yet it seems like the U.S. certainly is bankrupt in one sense, and what it's not going to get paid back. Eventually, there's some sort of negotiation, some sort of restructure. It seems to a large degree that the political response is just pretend it's not there, but
Right.
someone's on
Right.
the other side of that, and I'm sure they're not happy about it. And it comes down to what other way of doing it is there. And that is the question that we will pick up on in part 2 tomorrow, where Vince talks more about what he sees playing out in the gold and silver markets, which he has traded for a couple of decades and has some great insight into. Call one a little bit long, so I try to break these up and make them a little bit easier to watch, but hopefully you found his thoughts on the Fed today helpful. And again, tomorrow in part 2, we'll be digging more into gold and silver. Real quick note before we wrap up, I'd like to thank Kuya Silver for bringing us today's episode. Actually caught up with David Stein of Kuya Silver last week at the Silver Symposium. And here's a quick snippet of what they've been doing this year.
Since the beginning of this year, and even going back to late last year, we were able to consolidate a much bigger land position around the Bethania mine. That's really important for the future growth. It's really transformed Bethania from a mine scale project to a district scale project, which is really, really cool. We got our resource out, which was very, very positive. We made new discoveries, which are going to add to a future resource at Bethania. And then we got our PEA out as well, which demonstrated, very low costs, low capex.
Well, thank you, David, and thank you, Vince. Again, part 2 of the interview where we dig into gold and silver coming your way tomorrow, and I look forward to seeing you then.